All right, we have futures doing a whole lot of nothing. Traders sitting on their hands, well, when they start, 30 minutes until the cash trade.
You're Matt Miller, and I'm Katie Greifeld. Bloomberg Open Interest starts right now.
My point was, it is Fed Day today, and Wall Street is estimating that Powell's hawkishness could trigger a market sell-off, or at least that's what we're going to talk about. Iran says it will not surrender to Israel as the White House still weighs intervention in the Middle East. Does he or doesn't he? Plus, banks will get looser limitations for Treasury trades, but some argue that move could backfire on regulators. Katie, what are you watching this morning?
Let's talk about the chip stocks. Some interesting moves this week. We haven't really paid a lot of attention to them, but I want to point out Marvell right now up 4.6% right now. They had an AI event this week. The sales side is psyched about it. We'll talk about that. You also have Broadcom, some making the case it should be the Magnificent Eight. And then you have AMD, a third straight day of gains if this pre-market day gain holds. Remember, this stock was up 9% on Monday alone.
9%?
9%.
I don't remember it being up 9%.
Oh my goodness, get out of here.
We're also watching Circle. It extends gains even further after the Senate passed stablecoin legislation to create rules for cryptocurrencies pegged to the dollar. This stock is trading at 153. Well, this is the future, the pre-market, but $153. They went public. They sold shares, Katie, for $31. If the CEO had just waited 2 weeks instead of raising $1 billion, they could have raised $4.
You know, I think he's doing okay. I hear your point, but I think he's pretty happy. I think he holds a lot of shares. But, Matt, you were making the point that you take a look at the pre-market moves. Investors largely on the sidelines right now as they await the Federal Reserve's policy decision, plus a release of new economic projections in the form of the dot plot. We heard from former St. Louis Fed President Jim Bullard. He expects to hear concerns around slower economic growth.
If it was me, I'd be talking about slower growth due to the trade war, because that's what happened in 2018, 2019. And I'd play down the inflation effects because I didn't really see too much in that earlier trade war. I think the baseline would be here to get to September and make a judgment there about how they want to play this for the rest of 2025.
All right, for more, we are joined by Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, in the copy, I was supposed to say traders are on edge, but no one is really on edge, right? I mean, we expect a whole lot of nothing today.
We do expect a whole lot of nothing. The Fed is on hold. They've made it clear they're on hold. They want more data. They want more information on what the president and what Congress are going to do. And the data are supporting them at this point. We got jobless claims today that actually declined to 245,000. Non-seasonally adjusted, they dropped even more than that. Housing starts were terrible, down to a 5-year low, off by almost 10%. But everybody knows until the Fed starts cutting interest rates, it's not going to change a whole lot because people don't want to pay for the mortgage prices we're seeing these days. So, as you mentioned, Matt, Matt, you remember the Mickey Mouse Club, anything can happen day. Today's nothing's going to happen day. We're going to see a slight tweak in the Fed's statement because they've got to bring it up to date. But unemployment and inflation forecasts could rise, as Jim Bullard was talking about, but the dot plot going to be little changed because they don't really know what's going to happen, so they don't know how many cuts they're going to do.
Right.
And Jay Powell is going to emphasize that they are in good shape to wait at this point.
I do want to talk about the dot plot more. I know that Jerome Powell doesn't want us to pay too much attention to it. I just heard you saying not to get too excited, but I'm trying here, Mike McKee. If I wanted to get excited, it seems like whether or not it'll signal 50 basis points of cuts or 25 basis points of cuts.
Well, I don't think I would get excited about what's going to happen right now to the end of 2025. What you might want to look at is what's going to happen in 2026, because if the economy develops as everyone hopes and we get back on track and the economy looks up and the inflation comes down, the Fed can lower rates, how many times are they going to do that next year? The end of the year that we talk about all the time is sort of an artificial constraint. You also have Jay Powell in May of next year no longer being chair, and there is a bet. Edward Bolingbroke on Bloomberg today has a nice column on that. People betting on big rate cuts in 2026 when Powell's gone. So maybe don't focus as much on how many cuts this year, but how many cuts next year, how that changes.
Yeah, great column by our Ed Bolingbroke. Kind of echoes what we were hearing from Paul Tudor Jones last week. Mike McKee, always great to talk to you on Fed Day. You have fun this afternoon. Let's turn our attention to a Bloomberg News exclusive now, and that is that top U.S. bank regulators are planning to ease limits on bank trades of treasuries in an effort to bolster banks' roles as intermediaries in that market. Banking regulation reporter Katanga Johnson, he broke the news and he joins us now. Katanga, I actually want to go straight to the bank shares because this is something that we've been watching for a long time now. But you take a look at some of the pre-market action in the big names out there. It doesn't feel like we're seeing all that much.
It's really interesting. The industry has long asked for changes to this proposal. Regulators announced yesterday, the Fed in particular, that they would be looking to propose the changes next week. But the fact that the industry has really been expecting these changes could speak to what we're seeing before the markets open.
So what do we expect to see in terms of the money that they can make? That's what this is all about, right? If they have looser regulation, they can earn more profit. They can send more back to shareholders or buy their shares. How will this change that equation?
It's interesting. We'll have to see the details once it's proposed. But, one expectation the industry had was that regulators would either adjust the ratio, which they are going to do next week, we understand. But there was this speculation that they would also carve out certain assets like treasuries or reserves. It seems that that will not be an outright carve out in the proposal. Instead, regulators will ask commenters to weigh in on whether they should do so. But the bottom line here is that while the industry had long expected adjustments to the ESLR, they can now not just look for those adjustments, but be able to weigh in the specific ways that they'd like to see this measure impact their businesses. A little too soon to tell in terms of what it means for actual trades, but regulators really expect that by changing this ratio, that it wouldn't be as binding, that it wouldn't crimp lenders, the ability for banks to lend.
So we'll wait and see if it moves the shares. Traders are clearly focused on the Fed today, which is why they're not doing much in the markets. But Middle East tensions really loom, and I'm sure that's what everybody logged onto the Bloomberg to see first thing this morning. Iran's supreme leader said he won't yield to Israel. That defies President Trump's call for an unconditional surrender. And the president has been meeting with his national security team. He has raised speculation that the U.S. may join Israel. Let's discuss with Bloomberg Israel bureau chief Ethan Bronner in Tel Aviv. And Ethan, it does seem like the perfect time, right? Israel has done the difficult work, getting rid of Hamas, getting rid of Hezbollah, weakening Iran's defenses. Now, with U.S. bunker busters, they could completely take out Iran's nuclear capabilities.
Well, you very well expressed the Israeli argument to the Americans that this is the perfect time for them to come in. They've done all the hard lifting and heavy lifting, as you said. In particular, they've taken out all of these, or at least a huge number of launchers and of air defense systems, and therefore the Americans can come in, no boots on the ground, not much risk and enormous payoff. Assuming you agree with the Americans and the Israelis that no nuclear weapon in the hands of Iran is of terrible, huge importance for the West.
Well, beyond getting involved, talk us through some of the options that the U.S. administration is considering right now that were discussed yesterday in that hour-plus meeting. For example, the idea that, perhaps we're going to be speaking with Pakistan comes to mind.
Right. Pakistan is apparently carrying water for Iran. It's coming to say, look, Iran wants to talk. I think the problem is that Iran has always wanted to talk. But from the American and Israeli perspective, what it wants to say is the problem, which is that it's not willing to acknowledge the American demand that there be no enrichment at all on Iranian soil. That is the American demand, and that's the Israeli desire as well. So there's that. Then they're in this enormous equipment that the Americans have, right? These B-2s and the 30,000-pound bunker busters that only the Americans have, and that it can only be transported and lifted by B-2s, and that are necessary if you want to penetrate Fordo, which is one of the big enrichment sites, deep in a mountain, not far, about 70 miles from Tehran.
All right, Ethan, really appreciate your reporting. That is Bloomberg's Ethan Bronner joining us live from Tel Aviv. We do want to get a check on this market right now. Not too much to talk about on the index level. Slight gains when it comes to the S&P 500, when it comes to the NASDAQ 100. But let's go under the surface right now and talk about some
Let's get under the hood, Katie.
Let's do it. All right, pop in the hood. You can see we start off with Nucor up about 2.3%. It's rising after its second quarter EPS forecast beat estimates, Matt Miller.
Yeah, so Nucor is one of the winners here. Affirm is a gainer, and we just get confirmation of the report that PGIM is going to invest another $3 billion in Affirm. So there are a number of stories on this ticker, but the stock just continues to rise. And
Walmart.
Wow.
You can see shares up very slightly. The reason we have
in the
pre-market, we have that move up, that very small move, because if this holds, it would break Walmart's longest losing streak since 2004. It has fallen for 10 straight days. It hasn't done that since the early aughts. It's amazing, though. In that time, you add up those 10 days of losses, it only adds up to about 5%. So small moves overall, but they certainly do add up.
Yeah, it's not a huge drop. Walmart is still up 5% year to date, up 41% over the past year. And with my trusty comp function, I can see that they're up 157% in 5 years. So the stock has done well for investors. Coming up, the S&P 500 is, well, it was nearly back at its February peak. It actually fell almost 1% yesterday, so we're back under 6,000. Federal Reserve decision coming out today, and Wall Street seems to give very few concerns about what's going to happen.
Go to break.
Today. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. OpenAI CEO Sam Altman said Meta has offered his employees signing bonuses as high as $100 million. That's in addition to larger annual compensation packages as Meta, Facebook, Mark Zuckerberg, as they try and build a top artificial intelligence team. Altman made the comment on his brother's podcast saying, quote, "None of our best people have decided to take them up on that." Altman says people are turning down Meta's offers because the company is not great at innovation, which, how does that stop you from taking a $100 million signing bonus? New York Congresswoman Elise Stefanik is calling on the SEC to investigate Harvard's recent bond sale. She alleges that the school may have withheld material information from investors about its standoff with the federal government. Harvard sold $750 million of taxable bonds that priced on April 9th. About a week later, the university issued a supplemental disclosure revealing that it had rejected the government's demands to combat anti-Semitism. The university then listed disclosures of risks related to an ongoing conflict with the Trump administration. The SEC is not commenting. The question is, will she vote for a bill that continues to cap the state and local tax deduction for her constituents? Now, it's a big win for booze. New U.S. dietary guidelines are reportedly going to be less stringent when it comes to alcohol consumption. Language for the new guidelines will eliminate the long-standing recommendation that adults limit drinking to 1 or 2 drinks per day. Instead, Americans will be encouraged to drink in moderation or limit intake because of associated health risks. The guidelines are still under development and subject to change, according to the report. So, Katie?
All right, we will continue
Drink
to follow.
up.
We'll follow that one closely because it's still subject to change. But let's focus back on the stock market because despite wars, tariffs, and political upheaval, the S&P 500 still on the cusp of 6,000. That could change today after the Fed publishes its latest dot plot, with traders saying that forward guidance from the FOMC today could trigger a sell-off if it's hawkish. Joining us now to discuss is Bloomberg stocks and investment strategy reporter Alexandra Semenova. I'll ask the question that Matt asked in the break. Are people really bracing for this? Because it seems relatively placid if you take a look at the setup right now.
So the thing is, we're up more than 20% from the throes of April's sell-off. So it's not unlikely that investors will use any negative signal to lock in some profits. And today's Fed meeting could provide that if Fed Chair Jerome Powell is more hawkish than investors expect. Swap traders are expecting 56% odds of a rate cut in September. And if there's any indication indication from him that that might not happen. It could result in some selling. That said, the fundamentals still do look good. Earnings estimates are going up. We've gotten positive economic data, and trade deals seem to be moving in the right direction. So a lot of Wall Street banks have been saying that this could be an opportunity to buy the dip. JP Morgan actually turned cautious on stocks, but they said that any kind of volatility would be a chance to buy in.
So wait, so you're saying that if he's hawkish, Wall Street will sell, and Wall Street recommends buying the dip on that sale?
Yeah, and that could probably explain some of the price action that we've seen. The S&P hasn't really moved much in either direction. We're up something like 0.7% since May 20th, and we've been stuck below an all-time high without any real catalyst. So we could see a downside catalyst from the Fed. Obviously, there were a lot of issues, leading up to this Fed meeting where we're at the valuations that we were in the first quarter, but there is a little bit more uncertainty from trade deals. But at the same time, fundamentals are still looking good. We are just kind of experiencing these cross currents, and the market needs to see something in either direction.
Let's talk a little bit about what's priced in for this specific Fed meeting. We have this great bar chart, and it shows that the implied move in either direction for the S&P 500 is about 1%. You're taking a look at past realized moves, and 1% doesn't seem huge, but it feels like over the last couple meetings, the moves have been getting a little bit smaller.
Yeah, so this would actually be the smallest move since January. That's according to Piper Sandler data. The average realized move over the past 18 months has been 1.1%. My colleague Jess Menton has a great story on the Bloomberg terminal on this. So it's kind of expected to be a little bit uneventful compared to what we've seen in recent months.
Alexander, is there any are there any signs that it's institutional selling that we've seen in this market and retail investors buying the dip?
I mean, overwhelmingly so. If you see, this actually has been one of the most hated rallies that we've gotten in a while. Only 28% of the time have, in the past since 2010, have institutional investors been this underweight stocks, even as we're approaching an all-time high. It's really been retail buying a lot of it, and a lot of institutional investors still very neutral, kind of looking for more positive signals on trade negotiations.
All right, Alex, really appreciate the reporting. You have a fun afternoon coming up. That is Alexandra Semenova of our equities desk over on the Bloomberg News side. You take a look at the futures setup right now. Not too exciting. You can see we're up mildly on both the S&P 500 and the NASDAQ 100, down a little bit, and I stress a little bit when it comes to the small caps. And Matt, this kind of feels like payback for what an amazing May we had when it comes to the benchmark.
Right, up 6% in May, and it looks like we've been, or feels like we've been just moving sideways.
Treading water.
Ever since. Coming up, we're going to talk to John Stoltzfus of Oppenheimer. He remains bullish on the S&P 500. We'll ask him if the Fed scares him or if he's more concerned about attacks in the Middle East. This is Open Interest.
Welcome back to Open Interest. Oppenheimer's John Stoltzfus is out with an argument that Middle East tensions could be a boon for stocks. The chief market strategist says that, quote, military action and conflagration are often followed by a collective realization among investors that such destructive events eventually spur production. The eventual need to repair damage and rebuild inventories depleted by war activity eventually lead to the procurement of goods and services. I'm pleased to say that John joins us now at the desk. So reading this argument, it kind of reminds me of after you have a natural disaster. Unintuitively, that sometimes ends up being a boon when it comes to the economic activity, because you do have to rebuild. But talk to us about the timeline first, because it feels like this is something that's far off.
Well, I think, Katie, as you know, I've been in this business 42 years, so we've been through many times when geopolitical risk becomes much higher. And the market generally, initially, projects negatively in terms of the outcome. And then suddenly there's a realization that even within conflagration, there's need for food, there's need for military equipment and rebuilding inventories of military equipment. It's not that the markets are either cynical or hard, they're just realistic. And the world is about, our financial markets are about profitability, growth of revenues and profitability. And so when these things happen, generally speaking, it's not a good idea to move with the sell-off. The sell-off comes from the trading establishments. Traders naturally, short-term, are concerned with the near-term risk, capital risk. But for intermediate to longer term investors, these opportunities are presented in babies that get thrown out with the bathwater.
Isn't this, though, I hate to harken back to Economics 101 and draw this into philosophical discussion, but isn't this Bastiat's whole broken window fallacy? I mean,
gosh, I don't remember the broken window. That goes back to Rudy
if you break
Giuliani.
a window, right,
Okay.
then you have to hire someone to come and put the pane of glass back in, and it creates economic. But you're really just robbing from the future.
Well, you know, I don't think so. It just hasn't worked out that way. In fact, what usually happens is it provides for opportunities, again, for revenue growth, profit growth. Rebuilding is not a negative thing. And but it's not that I'm endorsing war. Believe me, I'm not looking forward to a host of emails saying I'm a warmonger. That's not it at all. But just looking at it, in the current situation, it looks awful for people who are in the Middle East, you know, and the higher risk. But in terms of where we are today, globally, the markets, I think, are responding pretty properly, essentially recognizing near-term capital risk for trading firms.
Well, it seems like we've gotten back up to a level, John, where everyone's questioning, can we go higher from here, right? We're just hitting that 6,000 level. And John's going to stick with us. John Stoltzfus from Oppenheimer will stay with us through the opening bell. If you look at futures, you can see we're not doing much, but that's not unusual for a Fed day, right? Because I guess people turn off the computers. So right now, up 0.1% on the S&P 500. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I am Matt Miller. We're looking at, because it's a Fed day, not a lot of movement here in futures. They are up, right, after a drop of about 0.8% in the cash trade yesterday. S&P futures are higher. NASDAQ futures are higher. Russell 2000 futures have a red arrow, but really not a lot of movement there. In terms of the opening bell, down in the New York Stock Exchange, you've got Allied Gold Corporation, I believe it is, celebrating their recent listing, and that stock has doubled year to date, so that's not bad. Down on the New York Stock Exchange, you've got Caris Life Sciences ringing the opening bell. Bring your daughter to work day. I love to see that. In terms of the stocks to watch, there is a lot going on under the hood, so to speak. So it's not just about the indexes. Katie Greifeld, what are you looking at? Specifically,
I'm looking at the chip stocks. You're going to find a lot of action when you take a look at Marvell. You're also seeing some movement to the upside as well in Broadcom and Advanced Micro Devices, AMD. Marvell moving higher after a whole wave of analyst upgrades. It had an AI event. The sell side really seemed to like that. Broadcom and Marvell, or AMD rather, continuing to build on the rally that we've seen over the last few days. So keep an eye on those chips here, Matt.
All right, we will keep an eye on those chip stocks. Don't ever want to get too far away from them. I have wanted in the last 10 years to get as far away from stablecoins as possible, but
stablecoins
you can't look away from this because Circle is up, what, 350% since its IPO, which was less than 14 days ago, less than 2 weeks ago. So amazing run up there. As I've said, Katie, they raised $1.1 billion in their IPO.
I know.
And if they'd only waited 2 weeks,
they should have had you.
They could have made that 4. They left so much money on the table, is my point.
They should have had you consulting on this IPO, but it is amazing to see this post-IPO pop. It's beyond that even now. It's going to be interesting to see if it cracks open the window even wider for IPOs, but specifically for crypto IPOs. But Circle shares, man, just have been stunning.
It's just, to me, it's a philosophical question, right?
You have a lot of those today.
We celebrate these massive gains after an IPO, but it's money that they could have to invest. All right, let's get back to John Stoltzfus, Oppenheimer, Chief Market Strategist, here on the set with us. He is bullish, and on a day when the Fed is expected to do nothing and maybe even show a dot plot with only one cut, how much does that matter to your forecast?
Not a heck of a lot. We really, I think I'm one of the few strategists on the street for a long time now has been a fan of the Fed. I think Jerome Powell has been doing the right thing. Once he got away from being behind in terms of where inflation was going and that whole transitory business, when you consider 11 hikes, and then 9 pauses after that with 3 cuts so far, and no recession. It's been remarkable. He's really been able to deliver the goal of the Fed, whether it's providing an economy that grows at a sustainable pace without producing untoward levels of inflation. And the other side of it is essentially not disrupting the job market so that you have full employment, somewhere between 3 and 4.2% unemployment.
Yeah, the way that I've been thinking about the Fed, it feels like almost a neutral force on this rally, not doing too much in the way to stoke it, not doing too much to get in the way either. Does that argument hold water with you, or are there any nuances that you would add?
Well, I would say, we're looking for 2 cuts this year, and we don't think we're going to get anything, today, but we think that probably in September, there's a good chance, another what we call a down payment by the Fed to show the market, in effect, that indeed they are looking to cut that benchmark rate somewhat. But I think we're closer to really interest rate normalization. I don't think we're going back to free money unless we have some kind of a crisis occurring.
Right.
And it doesn't appear to be. The economic data, whether it's related to the consumer or to business, overall looks like it's slowing, but it would be expected after all that's occurred and all that's out there. We're right about where we should be, is what we think when we look at it. And it doesn't look recessionary, but it looks like we kind of muddle along here, and gradually we get a sustainable pace in the economic recovery process from all that we've been through. That will likely see opportunity for stocks to move higher. But we want to keep our expectations right-sized in here. You don't want to be shooting for the moon.
By the way, I was thinking, yesterday I was listening to Mike McKee talk about President Trump has demanded that Powell cut by 200 basis points. And to be fair, President Trump knows more about interest rates than the Fed or Jay Powell or anyone else.
That's what he says.
According to himself.
That's what,
right.
But if Jay Powell were to capitulate and cut 200 today, would that be good for stocks? Would we see the 10-year yield actually come down on that? Is that how that works?
It would really depend upon the way the traders would react, and they might initially do it, and so they might all of a sudden just boost the price of stocks up and increase the price of bonds. And then I think they would probably pause and say, wait a minute, is this an Arthur Burns moment? The predecessor of Paul Volcker, who failed to curb inflation. So I think that's what, I think Powell is really looking here to preserve really to build his legacy as Fed chair. I don't think he's looking at another term. I don't think Trump is going to. I don't think so.
Yeah.
But it's the whole thing is, it's people who are prone to leverage, and of course builders and realtors are prone to leverage, naturally want lower rates. But if you look at where we are today, I mean, we're just getting down to what the last inflation numbers that we saw last week. What were they? They were on the 2.6s, 2.8s is what they were looking at when they came in, and that's getting close to the 2. But 2% remains elusive, and I think that it will remain elusive for quite a while because it takes a while to wash out inflation. Remember what happened to Alan Greenspan? He fought inflation back and forth for almost 15 years for his term at the Fed. This time it should be a lot shorter just because information is disseminated much quicker, and I think the Fed has a better handle on it.
Well, I appreciate the reminder that President Trump is a New York real estate guy. Of course he wants lower rates. I want to talk a little bit about money market funds, though, because, you talk about, okay, maybe we get 2 rate cuts this year. Maybe that kicks off in September. You think about the $7 trillion that's sitting in money market funds earning 4%. Is 2 rate cuts enough to move that money out of these funds? I think it's certainly going to move a good portion of it out because there's still people hiding out in the money markets. But I think overall, just what Eric Balchunas has said overall in that whole drawdown that we had earlier this year, the private investor keeps buying, and I think it's not so much that it's not an irrational exuberance. It's beyond. That kind of thinking. It's actually people are concerned that Social Security will not provide the same portion of retirement income that it once did. I don't think anybody thinks it's really going away. But with the end of, over the last 30 years, you had the end of defined benefit
pension plans.
Right.
And now you have
RIP.
And with what we've got, it's people have to act more like their own pension plan. And as that, they really are you really see it when you speak to private investors. That's why so many people are. I think why the multiples are as high as they are in large cap stocks is not irrational exuberance. It's a supply and demand question. You know, Yardeni talks about the Wilshire 5000 not really having enough stocks that qualify to be in that index because private equity has taken so much out of the public markets.
Yeah, it's wild. Companies aren't going public.
It's demand, you know, it's not craziness. And if you look at the performance this year of the sectors, well, from the lows, it was predominantly tech, communications, services, industrials, financials, the industrials and the communication services, tech, and what the heck else?
Perhaps utilities.
Well, materials jumped too. But from the peak, the only two sectors that are up as of last Friday were industrials and utilities.
Right.
The Utes. I mean, you look at that. You got it's a bifurcated gain. You know, everything else is still negative from that peak.
Well, John, we have to leave it there, unfortunately. Really appreciate the time this morning. That is Oppenheimer's John Stoltzfus. And let's look at some of the bifurcation in this market right now. When you take a look at the S&P 500 here, that is the SXXP, not the S&P 500. But hopefully we can bring up the S&P 500 because you have something interesting happening under the surface right now. We're going to get that up. You can see that there's more gainers than losers right now. 300 names in the green. Up at the top, you have Tesla, the biggest weight to the upside on this market. Maybe the banks waking up to that reporting from our team at Bloomberg News that the Fed and other regulators are looking at easing SLR rules. You can see JP Morgan up 1.25%, small moves overall. And it's a similar story when you take a look at the downside as well. NVIDIA, your biggest weight on this index. Microsoft trading spaces there. Eli Lilly and Zoetis. Zoetis hit with a downgrade this morning. Let's take a look at the sector level. It's pretty close to an even split, but you can see that it's actually moved in the minutes since I last checked. Energy up at the top here, up 0.5% or so. Consumer discretionary, the banks waking up once again. You take a look at what isn't doing too hot this day. You have technology and healthcare down at the bottom. NVIDIA and Eli Lilly are your weights there, Matt Miller.
All right, so we do have then some gains right now on the S&P and the Euro Stocks 50. The Stoxx 600 we know has fallen and is currently down in the session. After a year and a half of back and forth, the president finally agreed to sell U.S. steel to the Japanese. The Nippon Steel takeover is finally done. Those companies announcing the acquisition earlier this hour, and if you type X equity DES, you can see that it's no longer trading. Bloomberg's metals and mining reporter Joe Doe has been following all the details. And Joe, this looked like an acquisition. It looked like the president wouldn't allow the sale of U.S. steel to the Japanese. Now he has. Why?
Yeah, I mean, listen, I had a text message right before we got on here from a source who has been on this for 18 months and said, what a ride. Ultimately, what happened was the president of the United States came in and struck a deal with Nippon Steel, making more and more demands, as we understood it through a reporting since February, that ultimately came down to an additional $14 billion investment promise, in addition to the $14.1 billion tie-up. There's a point at which I think the president of the United States and his team looked at this and said, great, if they're going to continue to give us more and more in terms of investments, that's good for jobs, that's good for steel production in the United States. And one of the big ones here was the golden share, which we now have confirmation. The golden share does give a significant amount of power to the president of the United States. And it's not just Trump, it is in perpetuity. So we're going to see where that goes. I do think that opens up a whole new can of worms. Many people have been kind of questioning whether it would be an actual golden share. It's not an equity stake. But the fact that the president of the United States has a say in things like production cuts and capital investments and whether or not they can move the headquarters somewhere else is an interesting one that this steel industry in the United States is going to have to keep an eye on for the coming years.
All right, Joe, really appreciate your reporting. This deal that finally got done, closing a chapter there, that is Bloomberg's Joe Doe, who has been following it closely. Now, coming up, Slide Insurance making its NASDAQ debut after an upsized IPO. We speak to Bruce Lucas. He is the company's founder and CEO. Up next. This is Open Interest.
Coming up, we speak with Galaxy Digital's Mike Novogratz right here on Open Interest. For the fourth time in 2 months, an insurance company is hitting the market. Florida-based Slide Insurance is set to trade on the NASDAQ under the ticker SLDE. The company raising $408 million after pricing at the top of the marketed range. And joining us now on set on Bloomberg first is Bruce Lucas, Slide Insurance founder and chief executive officer. Bruce, great to have you on the program. And I will say congratulations on the IPO, but I'll ask, what if your stock goes up 350% in the next few weeks? Would you be unhappy that you didn't raise like $2.5 billion?
Yeah, it's one of those things where there's a trade-off to everything, and you want to see your stock perform well, you want to see your investors make money, but there's a balance between new investors making upside and old investors taking a discount at the IPO. So I think the term was champagne problem. I kind of agree with that. It's a champagne problem, but you know, I don't think I'd be upset to see it go up, but I'd have a little bit of regret that we didn't get the best price.
I'm so glad
I was talking
you're
about Circle,
here.
by the way.
Yeah, I think everyone got
Just
that.
for the viewer. You know, I was talking about Circle.
Very glad you're here since Matt has been banging this drum basically since Circle's IPO. I want to talk about your IPO in a little bit and the decision to go public now. You were telling us in the commercial break you founded the company 3-4 years ago, and you have this dynamic out there where companies really aren't going public anymore. They're staying private longer. So 3 to 4 years, that's a pretty quick path to the public markets. Talk us through that decision. Why now?
Well, this is my second rodeo. I took Heritage Insurance public over 10 years ago. And with our growth rate, I mean, this has been a rocket ship, that Slide. We've gone from 0 to $1.4 billion in premium in 3 years. Insanely profitable, great ROEs. And we see a lot of runway ahead of us. That now's the time to make a big investment in the Florida market. And we're prepared to make a historic investment in Florida insurance. The IPO market's pretty robust for financials right now. I think investors are looking for trades that aren't tariff impacted. And when they see fast performing, high growth, high ROE companies, we were pretty successful in attracting a lot of demand.
Why is now the time to make an investment in the Florida market? I look at this one big, beautiful bill, and I think, man, those states that don't have an income tax are going to have one soon, because the federal government is going to pay for less and less of your medical care costs.
Yeah, that's absolutely true. But I think the underlying factor in Florida, especially in homeowners insurance, is tort reform. You know, we had a big problem in Florida. We had 9% of all homeowners claims in the country, 80% of all litigation because of litigation abuses. The legislature reformed everything at the end of 22. Markets are now stable. The fraud has disappeared. Prices are starting to come down. It's a tremendous time to be scaling in the Florida market. And I think we've got a pretty accretive backdrop on the reinsurance markets as well that's very favorable for additional growth.
So Matt thinks Florida, and you think no taxes. I think Florida, and I think hurricanes and all those other scary things that happen in Florida. I feel like that
happen more and more often.
Exactly. Weather is getting more and more extreme. I feel like to be in the Florida insurance market, you have to have a pretty strong stomach, and maybe that applies to investors as well.
Yeah, that's so true. No one watches the Weather Channel more than I do, let me tell you. It's been pretty busy. The last 3 years, we've had 6 landfall hurricanes. 6. Wow. That's a record. Last year, we had 3 Cat 3 or higher landfall hurricanes. So, yeah, it can be a little nerve-wracking, but what you have to do is prepare for the worst. And that's what we do. We buy more reinsurance than any of our peer companies. You try to maintain low retentions. You want to try to lock in as much profit as you can, but volatility can really hit you, and it's all about where these storms are hitting, and so far so good. We took a big blow in Tampa this year with Hurricane Milton. Cat 4, eye wall went right over the top of my house. Climate change is a real thing, and we try to factor that into the way we buy reinsurance. Just buying more and seeing model updates where they're increasing losses, it helps to mitigate some of that risk. But yeah, you're right. It's a tough market if you're not prepared to deal with the stress of hurricanes.
Well, Bruce, it's pretty fantastic to have somebody with your expertise and your experience. I hope we can get you back on the program, and congratulations again on the IPO. Bruce Lucas,
thank you.
There, the founder and CEO of Slide Insurance. Coming up, AI talent wars are attracting astronomical figures for talent. Would you take $100 million bonus?
No.
More on that next. This is Open Interest. All right, so AI is killing some jobs, but it is blowing up salaries and signing bonuses for other. OpenAI founder Sam Altman says that Facebook, Mark Zuckerberg, Meta, is reportedly offering his superintelligence team potential hires $100 million signing bonuses. That's on top of massive pay packages. Listen to what he said on his brother's podcast.
They started making these like giant offers to a lot of people on our team, like $100 million signing bonuses, more than that comp per year.
It's crazy.
And it is crazy. I'm really happy that at least so far, none of our best people have decided to take them up on that.
So far, Meta hasn't commented. We're joined for more by Bloomberg tech co-hosts Caroline Hyde. And I mean, this story already got my attention as soon as I woke up.
100 mil got your attention.
Yeah, I mean, that's an Eli Manning contract in one signing bonus for a nerd, right? Not a football quarterback. And at the same time, we have Amazon and Shopify and others saying, if you're not using AI, you're not going to have a job here anymore.
And so maybe the superintelligence team will be doing themselves out of a job in the future, because we know what generative AI is really good at.
Oh, hang on. I'm sorry. I got to jump in. The president is talking about interest rates. I want to listen in to President Trump. Can we get that feed?
Europe had 10 cuts, and we had none. And I guess he's a political guy. I don't know. He's a political guy who's not a smart person, but he's costing the country a fortune. So what I'm going to do is, he gets out in about 9 months. He gets fortunately terminated. Biden, I would have never reappointed him. Biden reappointed him. I don't know why that is, but I guess maybe he was a Democrat. I got great advice from Mnuchin on this one. Great advice. But he's done a poor job. So we have no inflation. We have only success. And I'd like to see interest rates get down. Now, Biden did a lot of very short-term debt. So we have short-term debt coming due. And because of this guy's rates, if he'd lowered a point, I'd pay about a point less. Then if he'd lowered 2 points, I'd pay about 2 points less. And that's for 10 years, 12 years, 15 years, 5 years. It's hundreds of billions. It's even trillions of dollars that we're going to lose because of this too late. I call him Too Late Powell because he's always too late. I mean, if you look at him, every time I did this, I was right 100%. He was wrong. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower. It'd be nice to be 2.5 points lower. We'd be saving $800 billion, $700 billion. That's a lot of money, right? Think of it, for nothing, for absolutely nothing. We'd save $600, $700, $800 billion. We have, I think we're 38th now in interest. And we should be number one. We should be the lowest. But, and by the way, if he's worried about inflation, that's okay. I understand that. I don't think there's going to be any. So far, there hasn't. I mean, we have almost no inflation. We've done a great job. When I came in, we had a lot of inflation. We went through 4 years of the highest inflation in the history of our country with Sleepy Joe Biden. And Sleepy Joe. And he didn't know what the hell he was doing. And so we had the highest inflation we've ever had in the history of our country. And then it came down because when I got elected, it started dropping because people understood that I knew what I was doing. But now we have a man that just refuses to lower the Fed rate, just refuses to do it. And he's not a smart person. I don't even think he's that political. I think he hates me, but that's okay. He should. He should. I call him every name in the book, trying to get him to do something. I've been nice to him. I do it always. I don't know how to sell. I've been so nice to him, fellas, you wouldn't believe. Let's have dinner. Too late. I'd call him too late. Come on, too late. Let's have dinner. I do it every way in the book. I'm nasty. I'm nice. Nothing works. He's like just a stupid person. But I don't expect anything. Maybe he does a little bit, but we should be 2.5 points. Remember, Europe had 10 cuts. We had none. We're paying more rate, more interest than a lot of European nations that can't carry our suitcase. I'm going to be nice. There's another expression. You know what the other expression, can't carry your, you know what it is, but I shouldn't use it in front of the fake news. So it's very sad to see it. And what I'm going to do is I'm going to go very short term, like 6 months, 7 months, 8 months. Wait till this guy gets out, get the rates way down, and then go long term. Because we have a tremendous appetite for our debt, because our country is doing well. But think of it, I got a call from Congress 3 nights ago. Sir, we can't account for the money coming in. I said, that's a good problem. You know, the bad problem is we don't have any money. They can't account. There's so much more money than we thought is coming into the Treasury. We don't know where it's coming from, sir. I said, check out the tariffs. He calls back about a day later. Wow, I think you were right. Yeah, I was right. That's nothing. You haven't seen anything yet. More importantly than the money coming in, we have factories being built, AI, auto factories. 2 of them stopped yesterday in Mexico, you read, and they're coming here because they don't want to pay the tariffs. They can't pay the tariffs. It doesn't work. So I just want to wish you a lot of luck with the new flagpole. We have 2 of them, and we're going to do this one now, then we're going to do the other one. 11 o'clock or so, we're going to have a flag raising, which will be great. And I got to get these guys back to work. They're making a fortune. They're standing around making a fortune. But remember this, somewhere in this group is somebody that is going to captivate some movie producer. Not Harvey Weinstein, but somebody else. Harvey's seen a better day. So it won't be Harvey, but it'll be somebody. And it'll say, that guy is perfect for a movie. And you're going to become a star, and your friends are going to call you, and you won't even return their phone call anymore, you know? Because you say, what do you do for a living? I put up flagpoles. I'm not even going to talk to you. I'm a big movie star. So some way you have that. Anyway, let's have a good, they call it a lifting. They also use another word, but I'm not going to use that word. You know what that is? The word, it starts with an E. You know what the word is? If I ever used it, I'd be run out of town by you people. All right, so enjoy it. Doug, you're going to get some good. He's going to win another Nobel Prize, I think, for this picture. So maybe the flag will be even more exciting. But this is pretty exciting. That's some equipment, I'll tell you what. Look at that crane. That's some beautiful equipment. It's there's nothing like America. Have a good time, everybody.
Have you been answered questions about whether you are moving closer, or you believe the U.S. is moving closer to striking Iranian nuclear facilities? Where's your mindset on that?
I can't say that, right? You don't seriously think I'm going to answer that question? Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do. I can tell you this, that Iran's got a lot of trouble, and they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine. You would have had a country. It's very sad to watch this. I mean, I've never seen anything like it. It's so, you know, everyone thought it was going to be the reverse. I didn't think so. And I was telling them, you gotta do something. You gotta negotiate. And at the end, last minute, they said, no, we're not going to do that. And they got hit. Remember 60 days? And then came the 60. 61 is going to become a very famous number. That was one hell of a hit, that first hit. That was one hell of a hit. Not sustainable, to be honest. That's where it ended. It ended on the first night, yes.
Is it too late, though? Do you think it's too late to now?
Really, nothing's too late. The only thing too late is Powell. Powell's too late. Too late, Powell.
Have the Iranians reached out to you, Mr. President?
What?
Have the Iranians reached out to you?
Yes.
And what did you say?
I said it's very late. You know? I said it's very late to be talking. We may meet. It's I don't know. There's a big difference between now and a week ago, right? Big difference.
You said we may meet. This is about we may meet. This is about Vance and with possibly going to
It's about anybody. They even suggested they come to the White House. It's a big difference. But they've suggested that they come to the White House. That's, courageous, but, it's like not easy for them to do. But they suggest, because I can't go now because of what's going on. I had to come back early from the G7, which was terrific, by the way, in Canada. Really terrific, good people.
Is there a possibility of next week or sooner that
Well, I don't know how much longer it's going to go on. I mean, they're totally defenseless. They have no air defense whatsoever. We've totally captured. We've totally captured the air, Brian.
Yeah, Mr. President, you've been fairly compassionate towards the Iranian people's suggestions.
I know a lot of people from Iran, from New York, from Washington, mostly from New York. They're incredible people. They're smart. They're energetic. They can be difficult, but so can you. No, they're great people. Smart people. And those people are getting the hell beat out of them now. And it's really a shame. It's so stupid. It's so stupid. It's another one, Russia, Ukraine is so stupid. Would have never happened if I was president. You guys agree with that, right? Would have never happened if I was president. Putin would have never done it. And I spoke to him yesterday, and I said, he actually offered to help mediate. I said, do me a favor. Mediate your own. Let's mediate Russia first, okay? I said, Vladimir, let's mediate Russia first. You can worry about this later. But I think that's going to work out too. But so many people have been killed. The big thing with that one is far more people are dead than have been reported in the Ukraine, Russia. Many, many more people. A building falls down, they say nobody was hurt. It's like ridiculous.
Question on deportation.
Unconditional surrender. Two very simple words. Very simple. Unconditional surrender. That means I've had it. Okay, I've had it. I give up. No more. Then we go blow up all the all the nuclear stuff that's all over the place there. No, they had bad intentions. For 40 years they've been saying death to America, death to Israel, death to anybody else that they didn't like. They were bullies. They were schoolyard bullies. And now they're not bullies anymore, but we'll see what happens. Look, nothing's finished until it's finished. War is very complex. A lot of bad things can happen. A lot of turns are made. So I don't know. I wouldn't say that we won anything yet. I would say that we sure as hell made a lot of progress. And we'll see. The next week is going to be very big. Maybe less than a week. Maybe less. But is there anybody here that said it would be okay to have a hostile, very, zealots really, but to have a hostile country have a nuclear weapon that could destroy 25 miles, but much more than that, could destroy other nations just by the breeze blowing the dust. That dust blows to other nations and they get decimated. This is just not a threat you can have. And we've been threatened by Iran for many years. If you go back and look at my history, if you go back 15 years, I was saying we cannot let Iran get a nuclear weapon. I've been saying it for a long time. And I mean it more now than I ever meant it. Yeah.
Mr. President, a question on deportations, Mr. President. You said last week that changes would be coming for farmers who have seen a lot of the workers they rely on taken away. But then DHS said this week that worksite enforcement would remain in place, that it's a cornerstone. So what's your message to farmers?
We got to get the bad people out of here first, and we're doing that. We're taking them out by the thousands. Murderers, drug dealers, people that are mentally insane from insane asylums. What they gave to us, fellas, they gave. Oh, do we have anybody in here that's a member of the? No, I don't think so. You've known all these people for a long time. Any illegal immigrants in here now? If they were, they'll find out.
Right.
They'll be checking you. You won't believe it. Your whole life will be destroyed because of this press conference. Watch. They'll destroy these people. I didn't want to tell them that before they stood up. But they'll end up being, he's a so-and-so. This one is from you-know-where. Don't worry. I think you're going to be okay.
Sure.
I'll be right behind you. Far behind you. I'll be right behind you. Now, look, we have to take care of our farmers. We have to take care of people that run leisure, hotels. I mean, we have to take care of them. But most importantly, we have to get the criminals out of our country. And Biden let in thousands and 11,888 murderers. Many of them murdered more than one person. Can you believe it? Many, almost 50% of them murdered more than one person. He let them into our country. They emptied out the jails of countries from all over the world, from the Congo, from Venezuela, from all over the place. They emptied out the jails, many of them. I would. If I were running one of the countries, I would have emptied out my prison population into the U.S., and many countries did. And we're getting them out, okay? We're getting them out. Thank you very much. Let's watch this. Brian, go ahead. Are you okay?
I'm just going to follow up on the immigration real quickly.
Yeah.
Can you comment on the impact of the Trump card and how much revenue this?
Yeah, we have a thing called the Trump card. This has not been done before or thought of. And for $5 million, this is usually people that would either be working for companies like Apple, I think, is going to buy a lot of them, because they can't get people into the country. You know, if you come in through the southern border, you have no problem. You can be a criminal, you can be a drug dealer, and you have no problem. But if you go and graduate #1 in your class from a great school, you can't get a job because there's no access to getting it. You can't get a green card. So we're going to sell that to people, in some cases wealthy, in some cases not wealthy. They'll be paid for by universities. Look at Harvard. They got $53 billion. That whole thing is coming to an end. It's amazing what we found out. What a disgrace. They have $53 billion. We gave them 5, 6, and some people say it's as much as $9 billion over a short period of time. So that's very much coming to it. They want to make a deal more than, I would say Harvard wants to make a deal more than Iran wants to make a deal, and Iran wants to make a deal. I mean, a lot of things are happening on a lot of fronts, Brian. A lot of good things are happening. And frankly, you know, it's a little bit of a, as we used to say liberal, now they say progressive. I use the word liberal. Progressive's too nice a word because they're destroying the country. They're really destroying these liberal politicians are destroying our country. Look what they've done during Biden's 4 years. I mean, we're working on, so much of our effort goes to getting people out of the country that should have never been here in the first place. What he's done to this country, it's not him. He had no idea what was going on. Everybody knows that. It's other people. It's Lisa and this one and that, all these people, all this scum that was around the Oval, the Oval Office or around the beautiful Resolute desk telling this guy, here, do this, do that, and not even telling him. They just go over to the auto pen and sign whatever the hell they wanted to sign. Because say what you want about Biden. He wasn't for open borders. He wasn't for transgender for everybody. He wasn't for men playing in women's sports. But he has no idea what the hell, he has no idea. And they were very upset. They wanted Bernie Sanders. And after about a week of this guy, they said, wait a minute, we just hit gold. This guy has no clue. He'll do anything we tell him. And then they realized they don't even have to get permission. They just go up to the auto pen. That's a subversion. That's a takeover of our government. And you people ought to start looking at it. That's a takeover. Not only did they cheat, I guess you saw yesterday came out with China and the license plates, tens of thousands of cards. They used those cards to vote on the second election, my second, the one 2020. Because as everybody here knows, I won that election by a lot. But the only good thing I can say is this is a much more historic term than I think I could have had as a second term. This is a much more historic election. And now we're going to put up a beautiful flagpole, and we're going to put up a flag. And I hope you enjoy it. And let's see how real people work. These are real people. You're not real people. Your job is too easy. Okay? Thank you very much.
President, how tall is the flagpole?
Close to 100 feet.
You have a meeting today with the Pakistani Army Chief of Staff.
President Trump there taking questions on the White House lawn, talking about the Fed to start with, talking about Iran, talking about immigration, talking about Harvard. And I guess we will hear what he's saying right now on India. Let's listen in.
This man was extremely influential in stopping it from the Pakistan side, Modi from the India side, and others. And they were going at it, and they're both nuclear countries. I got it stopped. I don't think I had one story. Did I have one story written about it? I stopped a war between two major nations, major nuclear nations. I don't think I had a story written about it, but that's okay. You know why? The people know. The people know. Did anybody write that story about the war? Did anybody? Did you write it? Oh, did you write it? You wrote it.
These brothers have asked you to get more
adjustments that need to be made for Marine One departures and arrivals.
No, we put it so that Marine One is very far away. We did it in conjunction with the Air Force, with everybody, and everybody signed off on it. Now we have to have it far away. It's very far from Marine One's out there. It's out in the field. So you have to have a certain distance. We're about 3 times that distance. Okay? Thank you very much, everybody.
Can you share what you told Prime Minister Netanyahu about getting involved?
It looks like he is walking away here as the press asks questions about Prime Minister Netanyahu, obviously wanting to know whether or not the U.S. is going to join in Israel's attacks on Iran. The president said, of course, he's not going to share that information in an impromptu press conference on the White House lawn. Let's talk, though, about his demands from Fed Chair Jay Powell. He did say that he was concerned about the fact that President Biden didn't fire the Fed chair that President Trump appointed in his first term. Joining us to talk about that is Michael McKee, Bloomberg's international economics and policy correspondent. And to talk about what's going on in Iran is our Washington correspondent, Tyler Kendall. But, Mike, I first want to ask you, really my question of the day. I heard you discussing this yesterday. If Jerome Powell were to capitulate to President Trump's demands and cut interest rates, for example, today by 2%, would that really drive down yields across the Treasury curve? Would that really make our debt less expensive to finance?
Well, it's a good question you ask, Matt, in that sense, because if they did cut rates by that much, then there would be a reaction on Wall Street that could drive rates higher because people would be afraid, A, of inflation, and B, that maybe the economy is going into recession. So the impact could be hard to predict. It wouldn't play out exactly as the president wants, but it's a kind of hypothetical question because that's not going to happen at all. The president shouting into the void today about Jay Powell because the Fed started their meeting at 9 o'clock, so the chairman has no idea what the president just said. But Powell has made it clear he's not going to be cutting interest rates until he knows what the economy is going to look like, and that really depends on the president. It almost makes you feel a little bit, Matt, like in The Wizard of Oz. You've always had the means to do it, Mr. President. Just kick your ruby tariffs together at 3 times, and maybe things will be better.
And Tyler, I want to bring you in here as well because, of course, the president did weigh in on the geopolitical issues in the Middle East. He said he spoke to Russia's Vladimir Putin yesterday. He also said that Iran suggested that they come to the White House. What do we know about the discussions between the White House, Russia, and Iran?
Yeah, hey, Sonali. Well, we know that the U.S. has been in close contact with its Israeli counterparts, and we're starting to see these other strategic allies when it comes to Iran reach out to the White House. As you mentioned, President Trump confirmed that he did speak to Russian President Vladimir Putin, and we know that he has lunch today scheduled with Pakistan's army chief. Pakistan considered to be a strategic ally of Iran. We heard from their foreign minister yesterday, for example, saying that Iran would be willing to come to the negotiating table, but only if the Israeli airstrikes stop. And up to this point, we haven't seen any indication that there is going to be that let up. Now, of course, the big question here is what is U.S. involvement really going to look like going forward? Matt wrapped it at the end of the president's comments there, but when asked directly, he said, quote, I may or I may not. But he did say that there's a big difference between where talks stood from last week compared to now. So, of course, this is something that we are closely watching. The U.S. still says that it has assumed that defensive posture, has not yet gone to the offensive, but we should note that the U.S. has moved military assets into the region.
Mike McKee, Tyler Kendall, thank you both for getting in position quickly to wrap the latest. And joining us now, we're going to bring in Mike Novogratz. He is Galaxy Digital founder and CEO. Mike, sorry, president is a tough act to follow, especially in this environment. But he did bring up something that is worth asking you about, which is the direction of the Fed next year. You already see record futures wagers in the market with a lot of investors betting that the next Fed chair will be dovish. But given where we are right now, given the concerns about inflation, especially on the heels of all of this geopolitical tension, do you think that because the president wants lower rates, that the central bank can deliver them?
Listen, I think the big question is the president going to appoint the shadow Fed chair, right? There's a lot of talk that he's going to, already kind of semi-nominate someone, 9 months, 12 months in advance of when Powell steps down. That would be, I think, not warranted or not wise. I think it would create a really steep yield curve, right? people were like, wait a minute, if we're going to kind of give up Fed independence or going to start pressuring that, right? And so I think Powell's done a really admirable job of just holding the line on Fed independence. The president can say whatever he wants. It's not going to affect what Powell's doing. The moment that gets questioned for real, and there's pressure on the Trump administration to actually do this, I think that could be very, very negative for markets. The dollar would sell off pretty tremendously. Yield curve would steepen. And so we'll see. It hasn't happened yet. You know, Trump loves a lot of bluster, and we'll see if they go that next step. But I think that next step would be a really, from a macro trader, it would be easy. You would just sell more dollars and put on more yield curve steepeners. But I think it would be very bad for the country.
Why would, when I was a kid, Mike, we had a shadow Fed, of course, not in the White House, but Alan Meltzer at Carnegie Mellon put that shadow FOMC together, and they were quite vocal in their opposition to the moves that you saw from Greenspan, from Bernanke, and others. Why would it make such a huge difference if there was a shadow Fed sort of coming from the cabinet?
Well, because, again, for academics or for pundits to comment on, is Powell making a mistake or not? That's what we all do, like macro traders do, economists do. When it's seen being directed by the president, it's one step closer to no Fed independence, right? And listen, the people you hear names kicked around, Scott Bessent moving to the Fed. There's no way Scott Bessent is going to be, a Fed chair at the behest of doing whatever the president asks. It's just not who he is. Same thing with a lot of the candidates. And so, it will be hard for them to find a credible candidate that will do what the president wants, right? Almost by definition. And so I just think the closer you get to losing Fed independence, the worse it is.
By the way, Mike, this is why I ask. Really, the question I've been kicking around in my tiny little brain since a call for a 200 basis point cut came from the president on Truth Social is, would that really reduce debt service payments? Would that really bring the 10-year yield down? If Jerome Powell came out today and said, all right, the president asked me to cut by 200 basis points, so I'm going to do it. We're going to reduce the benchmark rate by 2%. Wouldn't that have the opposite effect on the Treasury curve?
It certainly would. Like the long end, 30 years, 10 years would sell off, not rally. And I think everyone who's been in, the study of macro for a long period of time, you see other countries have tried it. I mean, Erdogan did it in Turkey and it was a disaster. And so I think the kind of names getting kicked around would never do it, right? Kevin Warsh, there's no way he's going to take the Fed chair and do what the president says. They're going to define their independence. And so I have faith that we're going to continue to have independent central bank. And part of this is politics, right? President Trump is a master at politics, right? And so him having someone to blame is a good thing from him from a political perspective.
Mike, what is the trade? You had mentioned a little earlier that, this doesn't bode well for the dollar and the long bond could be under pressure as well. The 10-year, we're looking at it around 435 today. Realistically, where do you think it goes? And as a macro trader, would you go really short? Would you take that pain?
Listen, if I thought we were going to lose Fed independence, I would be limit short the dollar and limit short long bonds. I don't think we're going to lose Fed independence. I really don't. I think, like I said, I think Trump likes to bluster about this stuff, but I don't think he's going to cross that red line.
What do you think will happen to risk assets if President Trump joins Israel in support of an attack in Iran? If we contribute bunker busters, if we contribute actual troops to a full-blown war, how does this market, which has been pretty good at ignoring geopolitical issues over the last few years, how does this market then react?
Yeah, it's a great.
While we're throwing up hypotheticals, Mike.
It's a very difficult question. I think, listen, if we went with bunker busters and took out the one big facility that everyone's talking about, the immediate reaction would be oil up, stocks down, probably even dollar stronger, just because people are short the dollar and people want to get out of risk. I think Trump would only do that. Like, when I'm thinking through the logic, if he would then say the war is over, Israel stand down and have a prearranged agreement with Israel that, like, we'll take out that one facility and then that's the end of the war, and say the same thing to Iran and try to declare peace at that point, that could be wildly bullish. It's an unbelievably tricky situation. If we just enter the war and it's protracted, categorically bearish. But if it's a one strike declare victory, it could, actually be the exact opposite.
I want to look at risk assets for now. You're looking at Brent crude trading around 75. This fear about oil prices rising higher, causing a dent in the trade in the last couple of days. The S&P 500, there's a sense by a lot of the market that it's not even just this kind of underlying inflation or geopolitical risk environment or even these big picture what ifs that you and Matt have just been talking about. It's this idea that even if the Fed is just a little hawkish today, then it could send a lot of this recently found risk appetite off the train. What do you think happens here? I mean, what are the trades that set people up for the rest of the year, given all of these uncertainties?
Yeah, it's, the stock market has been a conundrum to people because it trades spectacularly well, despite what seems to be all kinds of geopolitical issues, and internal issues, right, between tariffs and wars and this, the fights between, Trump's parade on one side and the No Kings parade on the other, right? All this discord, the stock market keeps chugging along. Partly that's because unemployment stays low and retail continues to be a participant. I think partly because of this giant data center build, right? This huge infrastructure AI build that's happening, which is adding incredible amounts to GDP. I've come to realize that despite bad government, we have such amazing capital markets and such an amazing entrepreneurial class that it's kind of holding off what feels to be all this, uncertainty. And so stocks don't feel like they want to go lower. Everyone I know has been underweight them, think they're overvalued. They trade like they want to go higher.
Mike, we only have about a minute or so left here, but we still want to ask you about crypto. We want to make sure we're getting your thoughts there, because if you joined us just a couple of hours ago, we would have asked you about the stablecoin bill and what that actually means for the future of finance. You have, of course, companies tied to it, particularly Circle, just flying since its IPO. You run an investment bank. I'm sure you have thoughts about how that should have been priced ultimately. And you have companies like JP Morgan saying that they're going to get in a bigger way. Amazon, Walmart. Do you think something fundamental is going to change about the financial system now that that bill has crossed the Senate?
Listen, we set up Galaxy 2017 with the idea that institutions would finally come to the market, and they're here. And it's a really exciting time. We're going to get the stablecoin bill and then hopefully a market structure bill. And it's going to bring in TradeFi into this technology. We're going to see tokenized equities. We're going to see perpetual futures, which is a crypto idea, be brought into the U.S., both for crypto and for non-crypto. It's a different way of looking at derivatives. And so I think, like, what I'm thinking from our firm's perspective is we're going to partner with people, we're going to have white label solutions for people, and we're going to have our own solutions for our customers. That every crypto company is now thinking, how do we go to this next chapter?
Mike, I got to wrap you there, unfortunately. We're running out of time, running into the hard break. Mike Novogratz, really appreciate your time today from Galaxy Digital. This is Bloomberg. Let's get a check on the markets right now. We are an hour into the session, and we are seeing a gain of 0.5% on the S&P 500. This after a drop of almost 1 full percentage point yesterday, so we were down under 6,000. We're back up over it. Crude had been rising, and after President Trump's comments that Iran is interested in talks, that price has fallen. It's not new information, but he didn't seem incredibly hawkish on the lawn of the White House during this impromptu press conference. You do see 10-year yields continue to come down, 436, 437 the level there. So we've seen a lot of volatility in yields lately, and Sonali, right now it looks like the market isn't not too concerned.
Not too concerned, as you're saying. The S&P 500 still above 6,000. So as long as we stay there, we are off the worst of it. But joining us now for how to chart a course amid all of the uncertainty, we're talking now to Chris James. He's global head of Blackstone's Tactical Opportunities Group, known as Tech Opps, chairperson of Blackstone's private equity strategies, and Blackstone's Tactical Opportunities business has $34 billion of assets under management. Just a little bit of an educator here. Tech Opps really forced a lot of the private equity world into this new business, debt, equity structures. You really get into what is kind of most opportunistic in a lot of ways. What are the types of opportunities that you see right now to put to work?
We are a hybrid capital investment strategy, investing in between private credit and private equity. And I think we realized 13 years ago that there's a lot of opportunities out there outside of just loans and buyouts. And particularly in times of uncertainty, a lot of volatility, it is where you see a lot of valuation gaps between what buyers expect to sell their assets at, what buyers want to buy, and sellers want to sell that. And that is, for us, a great opportunity to kind of step in and be that solution, be that bridge to ultimately get deals done. So right now is actually quite interesting when you speak about the volatility and the latest Trump announcements. We expect to see more deal flow for our business coming out of that.
Are sellers willing to let go? I mean, in this kind of volatility, does that make people more defensive and want to hold on to the assets that they have, or are they willing to get out?
I think it does two things. It kind of chills activity more generally, especially on the buy side in terms of underwriting that go-forward kind of performance of the business, given that uncertainty. And also, it dampens kind of values that sellers want to sell at, i.e. they have reserve prices to sell control of an asset, and that also dampens that. So that is, again, where that gap kind of grows and lets us kind of step in and develop capital solutions to ultimately complete transactions.
Let's talk about a specific deal. CoreWeave has really struck the imagination of Wall Street in so many ways. It's down today, but really it's up more than 4 times since its IPO. It's incredible. This is a company that you lent to, that there were a lot of questions about the capital structure heading into the IPO, yet it's kind of blown people away. What does that say about the next set of private equity-backed, debt-heavy IPOs around the corner?
I mean, the CoreWeave transaction was interesting for us because it was a GPU financing, in fact, first of its kind in terms of back in July of 23, developing a solution for these companies to buy more compute power. And ultimately, we did a GPU financing for CoreWeave to essentially buy thousands, tens of thousands of NVIDIA chips to ultimately deliver that compute. I do expect more of those type of transactions because if you believe in this massive AI revolution, to be able to, for the hardware and the infrastructure to support that, we, as Tech Opps and more broadly as Blackstone, can be the, if you will, selling the picks and the axes in the respect of this AI gold rush. So to your point, in that theme around AI digital infrastructure, it is, I think, a quite positive place to be in terms of cap-heavy businesses where we can finance into that growth.
So I hear you loving certain parts of the AI trade, but does that mean that the IPO market might not be open for everybody? You kind of have to be in the sweet spot.
Agreed. I do think given the volatility and uncertainty, there's going to be an open and shut kind of IPO market, which again, I think for us and our capital and Blackstone more generally is an opportunity.
How much do rates, I mean, I'm sure rates matter to you, but at what levels do rates start to matter to you?
I think when you see significant spikes in rates up or down, it's not really how much the rates increase, it's how quickly they increase or decrease that really matters, and it ignites more uncertainty, more volatility that enables, I think, more deal flow for our business.
When we were at 470 earlier this year, it didn't seem like people were as concerned as you would have expected.
I think that's true, because I think people are kind of seeing through that kind of, and again, with kind of rates stabilizing and some of this tariff uncertainty coming off, some of the, the latest dynamics on the wars coming off, I think people were relatively calm. And if you think about what we're seeing through our portfolio companies in terms of the underlying economic performance of our businesses, it's pretty good, right? Labor is kind of in balance. Consumers continue to spend. Inflation is kind of decelerated. So we're quite, I think, constructive on the kind of go-forward economic outlook. And notwithstanding these shocks here and there, in terms of a war or some news headline there. Looking through that, we're pretty constructive and positive on the go forward.
I want to switch gears for a second, get your view on something else you're working on over at Blackstone. You're one of the main people that's making it possible for a broader amount of investors to get into private equity. This has been long an institutional business, and Blackstone and everyone else is trying to figure out how to make it more retail friendly. How far can that go? And is there demand right now, given the volatility we're seeing in markets, the high rates, the concerns around private equity? What are you seeing?
We think it could be massive. And the backdrop for us is, for over a decade, we've been seeking kind of to deliver solutions for individual investors, recognizing that individual investors should get the same benefit of private markets that institutions have gotten for decades, which is to say better returns over cycles, more diversity, bigger investable universe. All of those should be available to individual investors. So we've been thinking about solutions for those individuals for a long time. We've done this in real estate and credit. We recently launched our private equity strategy for individual investors about 18 months ago. And we have been enthusiastic about it. And we think increasingly individuals are enthusiastic about it because, again, the returns, the investable universe, and just the diversity, I think, lends itself to what they want. And I think heretofore, what they have lacked is accessible products. And so we've developed those accessible products. So we do think this is a massive trend, and it will only grow, and we're going to kind of continue to develop solutions for those individuals.
All right, Chris, great to have you on the program. I hope we can get you back in here because it's a fascinating business, and I think our viewers want to hear more about it. Chris James there of Blackstone's Tact Opps group. Let's get a look at some of the single stock movers at this hour. Circle is one that we just can't stop looking at.
Incredible.
I mean, it's now up to over $160 a share after going public for $31 less than 2 weeks ago. The Senate passed the stablecoin legislation. I think it's like the Genius Bill or something to create rules for cryptocurrencies pegged to the dollar, and that is good news for Circle.
Good news for Circle. There are other places that are some interesting movers too. Marvel Technology gaining on optimism over AI.
Yeah, raising their TAM. I mean, just because you boost your addressable market estimate, you all of a sudden get a boost of 10% in your market cap. I think it's pretty fascinating.
But of the beloved AI names, this probably didn't get as much love as, say, NVIDIA had over the last year and a half. So a day is worth a lot for Marvel. Nucor is also rising, only about 2.7% right now, but second quarter EPS beat estimates. I do want to say, because we've been talking about IPOs, Circle, CoreWeave, also Slide Insurance, we're looking at that going public today, even amid all of this volatility, which is why this is remarkable. The shares are indicated to open at $34, and the IPO was priced at $17. So there's another pop.
Yeah, I actually
on your hands.
had Bruce Lucas, the CEO and founder, on the show today, and I said, would you be angry if you sold shares at 31 and then they were trading at 160? He said it's a champagne problem. So he would be concerned, maybe, but not unhappy. Coming up, U.S. regulators are planning to reduce bank capital rules. We'll discuss the potential changes with Rob Holmes, Texas Capital Bancshares Chairman, President, and CEO. He has many titles. We could probably list off a few more, but basically he runs the business there. This is Open Interest. Coming up, an interview with former Fed Governor Betsy Duke. That's at 4 p.m. New York time. This is Bloomberg.
Now, the Treasury Secretary has been talking about it, and it might come to a bank regulator near you. Top U.S. bank regulators are looking to unlock the $29 trillion Treasury market, and the plan is to reduce the enhanced supplementary leverage ratio, known as the SLR, by up to 1.5 percentage points for the biggest lenders. That would lower their capital requirements and make it easier for them to hold Treasuries, which now face a higher capital charge than some other types of assets. Now, let's flip up the board here, because not everyone thinks this plan will unlock the Treasury market in the way that is being telegraphed. Now, the idea here is, if anything, it might force banks who wish to increase their U.S. Treasury holdings to buy more bills rather than coupons, providing a less than hoped for relief on long end yields. That's according to the foreign exchange and macro strategist at BNY Mellon, Matt. And this is the push-pull. Will these rule changes help the Treasury market out at a time of massive issuance?
All right. Thanks very much for that setup, Sonali. For more on the potential changes and their effects, we're going to talk to Rob Holmes, Texas Capital Bancshares Chairman, President, and CEO. And Rob, I get the feeling that this is a rule change that's going to have a big effect on the biggest banks. But how much is it going to affect regional lenders? How much is it going to affect Texas Capital?
Well, I think you're right, Matt. I think it's going to affect the largest banks for sure. The smaller banks and regional banks, as you know, got in trouble by holding too many treasuries and the wrong dated treasuries and not managing their assets the right way. So I think the smaller banks and regional banks will be doing much better this next go round. And at TCBI, we're very, very focused on being well capitalized. Since we got here, our tangible common equity to assets is over 10%. Our CET1's 11.6 and growing. And I think you got to be capitalized the right way and be ready for any market or rate cycle.
Now, to that point about treasuries being volatile, even the largest banks, you think about how Bank of America has fared from holding too many treasuries at the wrong price. It did weigh on them. Are treasuries...
SVB?
Yeah, SVB as well. Do treasuries have more risk for banks nowadays than meets the eye? Are rule changes going to make banks really want to hold treasuries anyways?
Well, look, I think it's more about the individual bank's ALCO and managing their assets and liabilities and doing it the right way. Treasuries are a wonderful asset, a wonderful security to invest in, and an important component of a bank capital structure. So I don't think it's the treasuries. I think it's the individual bank management's ALCO and managing their assets and liabilities.
Let's talk about private credit here, because it's another area where some have voiced concern, but a bank like yours invests deeply in it. I imagine that's because you have the knowledge, you're looking at the deals, and you're comfortable with them. But how do you feel about the sort of opacity of that market?
Look, the size and scope of the private credit market continues to expand, and we're going to be a part of it. We were on the cover of over $25 billion of debt placements last year. And a lot of that was private credit. We were a top 10 arranger of bank debt in the country for middle market companies, and we led two of the largest institutional debt deals each of the last 2 years. So we're broad in the debt capital markets. Private credit's a part of that. As you know, publicly, we're raising a fund right now that I can't really talk about because we're offering securities. But we said publicly it's going to be for middle market companies, think 30 million, if you will, 30 to 40 million EBITDA. And we have a good view of the market. Some people have said that we're the largest, and best we know, we're the largest lender to Texas-based business of any Texas-based bank. So we have deep expertise. We have different segment expertise as well: healthcare, diversified energy, TMT, FIG, and the like. So we're really, really excited about private credit. We don't go to clients and saying, look, you need bank capital. We go and say, what's your problem? We have a solution for you, and we take them to the right capital markets and get them the right solution.
Rob, we've seen a spike in the oil price, but it was holding in the low 60s for quite a while, and that makes me wonder about how the economic health of Texas is faring right now. How is it?
Well, Texas is doing fantastic. It's the 8th largest economy in the world. It's the youngest workforce, the 2nd largest workforce. And
but does that
growing.
continue
we
at
have
$60
16 Tier
oil?
1 universities.
Or do you need it to be 75?
Well, yeah, because, well, you need it to be 70 and above to really start drilling more. But the fact of the matter is there's no segment of the Texas economy that's greater than 9%. Oil and gas, even though we're the #1 producer of it, and by the way, wind and solar too, that's only 9% of the Texas economy, and like number 6 in terms of size. So the Texas economy is greatly diversified: semiconductors, technology, healthcare, financial services, business services, and the like. So it's not like the Texas of years before where we're reliant solely on the energy sector.
Rob, we thank you so much. Come back to talk to us more about the economy. That is Rob Holmes of Texas Capital Bank Shares. Now, coming up, we're going to speak with Anushka Gupta. She's America's head of Goldman Sachs' Apex. Why she thinks she's still bullish on the Magnificent Seven. We're going to talk about all the risk under the surface and all the opportunity for her clients. This is Bloomberg Open Interest.
Welcome back to Bloomberg Open Interest. I'm Matt Miller here with Sonali Basak. Let's take a look at what's going on in the markets. Just about 3 hours away from the Fed release. Right now, the S&P 500 is gaining 0.5%. So maybe if you see a hawkish Jerome Powell, that'll turn down. But I guess investors are not anticipating it. Crude coming back down after a press conference in which President Trump said that the Iranians do want to talk, and the 10-year yield holding at 436. So everything seems pretty cool, right?
Cool out there. We have crude off the highs, but also off the lows, and actually almost every major sector in the green. So calm markets. And speaking of them, we're going to now bring in Anushka Gupta. She is America's head of Goldman Sachs' Apex, where your clients are watching this volatility. I'm wondering how they are behaving. You see still money market fund assets still quite high. People seem to still be keeping some dry powder on the sidelines. Are they holding on to cash still, or are they ready to find places to deploy, or are they waiting for some of this tension to clear up?
Yeah, thanks, Sonali and Matt, for having me. It's great to be here. You mentioned clients, especially our family office clients, do have a pretty balanced approach to investing. They hold diversified portfolios, but also do lean in when there are periods of dislocation, to your point of having dry powder, having that flexibility. So we have seen quite a lot of activity in the public markets in particular this year, given the volatility. That was evidenced by selling vol at, in sort of the April tariff-induced sell-off, to finding pockets of the market which offer value, like healthcare based on the valuation pullback, to tech more broadly given the innovation cycle, and financials.
What are the pieces that you guys like the best? I mean, in terms of factors, style, in terms of industry group, where are you most interested?
The thing we come back to is earnings growth. What drives performance on a long-term basis is earnings growth. If you look at let's just look at the U.S. markets broadly. Over the last decade, earnings have increased almost 96%. And compared to the rest of the world, that number has been 60%. And so we find that driver to be pretty meaningful, and actually has underpinned why the Mag 7 has rallied so significantly, because that earnings growth number over the last decade is close to 500%.
So is that just for your U.S.-based clients? Because you recently brought together about 200 family offices from around the world. We talk a lot on this program around those international investors, how they might feel about U.S. assets right now. And the conventional narrative is there's some fear under the surface. They might be holding off. You see that in places like the long bond and places like the dollar. Is that consistent with what you're seeing among your family office clients in other parts of the world?
Yeah, we just hosted our annual Apex Family Office Symposium, and we brought clients, 200 clients from over 17 countries. So, Sonali, to your point, it was definitely a global perspective. Look, there's no question that the discussion around U.S. preeminence has been a topic. Clients are asking about how they should think about hedging their portfolios, especially from a currency perspective. But honestly, on the margin, we see, from a Goldman Sachs perspective, and our clients hold on to this U.S. preeminence view. And, while tactical shifts do happen, especially on European markets and dollar hedging, the overall perspective feels much more balanced than the headlines might suggest.
Yeah, it's interesting because the narrative has been, these are foreign companies, your clients, right? The ones that own these companies, that are selling stuff to the U.S. and then using those profits to finance our debts, right? And that they're no longer interested in doing that. The dollar has dropped 10%, and a lot of people are forecasting, Paul Tudor Jones last week here, saying it's going to drop another 10%.
Yeah.
But you're saying they're still interested. They're looking through that.
They are, there has been more discussion, I would say, on the currency hedging aspect as opposed to changing their outright asset allocation framework. So we do see the U.S. preeminence view holding. There has been a lot of discussion and interest tactically on European markets, particularly based on the German spending bill recently. And so those areas of the market are a focus. If you think about how investors have owned U.S. assets, they've done so for a long time on a non-currency hedge basis. And that's been the right call. But clearly, since April onwards, that has been called into question. So we have seen more hedging. But given, to your point, the 10%-ish move that we've seen already, we could see that continue, but not with the ferocity that we've seen so far.
Matt and I have been talking a lot about the risk appetite in markets, but also the stunning amount of risk appetite in IPOs.
Yes.
It's like everyone that's flown out the door recently has just faced this tremendous pop. You're seeing it today. You saw it with Circle just days ago. What are your clients saying about wanting to buy in? Are they blanket looking at everything and saying, give me the new stuff? Or are they saying, well, wait a minute, there's only some sectors that we're willing to get into?
Yeah, I think, our family office clients are pretty balanced, as I'd mentioned before, but the IPO markets have provided a lot of exciting signals recently. We've had almost a dozen IPOs in the US this last month, and performance has been strong, and demand and subscription levels have been really strong. So we think that will continue to spur interest. Relating to family office clients specifically, sometimes they own companies when they're private. They add to positions on their IPO. They really think about owning companies through their life cycle. But, the price performance is certainly encouraging, and investors are thinking about how to balance not only growth rates that are strong, but also profitability metrics that are important.
Anushka, great having you on the show. I hope you'll come back and join us again here on Open Interest. Anushka Gupta there from Goldman Sachs. Apex. Let's get a quick check on the markets right now, almost an hour and a half into the session. And, Sonali, it's funny. I started off the show saying traders are on edge, worried about a hawkish Fed, looking to sell equities. That is not happening, right? Nobody's on edge in this market. The S&P is back up 0.5%. Yes, it was down almost 1% yesterday, but we're still at 6,000. Treasuries are at 430 and change. I mean, people are really sanguine.
People are really chill. You look at the VIX, and even amid all of the headline risk and volatility, we really didn't get much further than 21. And so the market has been calm, but yes, a lot of headline risk, especially today. What do we have later?
We have the Fed decides. That's our special today. Host of guests joined, including former Vice Chair Richard Clarida. Tune in for that at 1:30. This is Bloomberg.